Okay, this is letter number C on what we're doing here with the glossary. A hedge is a transaction intended to reduce risk. It often refers to taking a futures position that is equal or opposite from one's position in the cash market. If a producer has 5,000 bushels growing in the fields, the producer sells a 5,000 bushel contract in the futures market exchange. When the producer goes to sell the grain in the local cash market, the producer then buys the contract back, thus negating the original hedge. One way of looking at it is like this. Not that long ago, we had the Super Bowl, and if you wanted to hedge your bet, you could bet somebody that the Giants were going to win, say $10, and then you could turn around and bet somebody $10 that the Patriots were going to win. You've just offset it. It's a little more complicated than that, but that kind of explains it. You're more or less limiting your risk by doing one thing or the other. It's called a hedge. A hedge to arrive is a cash market forward contracts in which the futures price has been fixed. It's basically a local forward contract that's based on futures, also known as futures only. It's done through local elevators. These are actually pretty nice little tools, but they did get a dirty word a number of years ago. I think it was back in the 1990s. In the money is an option on a futures contract with an exercise value. Do a little punctuation change there. For example, if you have a $2 bushel call, it's in the money. If it's in the money 50 cents if the futures market is trading at 250. Likewise, if you had that $2 put, you're expecting prices to go down, and prices go down to $1.50. You're also in the money. I probably need to update these to more modern times, but that gives you an idea of being in the money. Obviously, there's an opposite of that called out of the money, and on that call, your option where you were expecting prices to go up, but in fact they went down, and if it goes down to $1.50 on that $2 call, then you're 50 cents out of the money. On a put, you're putting in a floor, so you're expecting prices to go down, but if prices actually go up, then it goes up to 250, then you're out of the money 50 cents. So it's just the opposite. In the money, your option is going to gain in value. Out of the money, your option is going to go down in value. Intrinsic value is the amount by which an option is in the money. And inverse basis we had talked about previously, where the local cash is higher than the underlying futures price. An example is the local elevator offering $2.30 for delivered corn, and the futures market for December corn is trading at $2.10. This one would have an inverse basis of 20 cents. It's usually a good time to sell. A lien is a security interest to secure a debt in a bank. The bank may take a lien on a growing crop to secure a loan to the grower. If the grower fails to meet their obligations on the loan, the grower may be required to give up the grain to meet their bank obligations. There's also in Illinois what we call the landowner's lien, to where if you give within 6 months of the sale of the grain, you give notice to the elevators where the farmer has indicated they can take grain. In Illinois, the landowner actually gets first position lien on that grain. Last trading day is the last day to which trade may be occurring on a given futures or option contract. In other words, it will expire eventually, usually in the close to the middle of the month. I have to go back and look and see exactly when that is. It's either the 10th or 15th, and I apologize for not knowing that right off the top of my head. Leverage is the ability to control large dollar amounts of a commodity with a relatively small amount of capital. It can be accomplished through margin accounts. In other words, if you buy a 5,000 bushel contract that's selling at 10,000 bushels, that's $50,000. Rather than putting up $50,000, remember it's only trading out paper trading, you may have to put up a margin, which could be, say, 10% of that. And basically, if the market moves against you, the person of the opposite position wants to know you're going to have the money there to pay for it. And that's, again, leveraged through a margin account. Being long is one who has bought a futures contract or owns a cash commodity. It's in your possession. A long hedge is buying futures contract to prevent possible increasing prices of commodities. It's again buying a futures contract. Margins we just talked about with leverage. It's good faith money. You want to make sure you have it in case the market moves against you. Remember, most futures contracts are just paper, and so they don't expect you to pay for all of it, but they expect you to put the money up front that if it could move against you. If you, say, buy an option, of course, there won't be a margin because you have your premium. If you sell an option, then the market could move against you, and so therefore they do require having that good faith money or a margin account. A margin call is from a clearinghouse or a member of the clearinghouse, a broker, to bring deposits up to a minimum required level, whatever that minimum is. But again, if it's 10% on that contract of 10,000 bushels at $5 a bushel, it's 50 cents or $50,000. If it's 10%, they require you to maintain $5,000 in there. If the market moves against you, say $7,000, then they're going to require an extra $7,000. Likewise, it can work in reverse as well. The metric ton, which is what's often used when looking at world markets. It's basically 10% higher than our typical tons. A minimum price contract, a cash grain contract which the buyer agrees to set as floor price but no ceiling. The buyer uses options to offset the risk. They are a popular way for farmers to sell cash grain yet retain the chance for higher prices. Nearby delivery month, the futures contract closer to expiration. And if we go back to the Andersons, and we can see right now we're in February, the nearby futures contract would be MAR, which is March on corn. No price established, a contract between the producer and the warehouse that transfers title to the warehouse or the elevator, with the sales price to be established later. You're giving up ownership. Offset is taking a second futures position opposite of the initial. You buy a futures contract, you offset it with the sell of a futures contract. You sell a futures contract, you offset it with buying a futures contract. 99% or more of all market participants will close their futures position by offsetting another rather than taking or making delivery of the commodity. The investors don't want the grain, generally speaking. Open, the period beginning at of a trading session officially designated by the exchange in which all transactions are considered to be made at the open. That's the beginning. Open interest may represent either the sum of money on all long or short futures contracts in a delivery month, or one market that has been entered into and not yet liquidated. And that's what I talked about earlier. If you bought one, say 10 are bought, 8 are sold, the open interest would be 2. But it could also be representative of money. Open outcry is a public method of public auction for making bids and offers on trading pits and commodity exchanges. I would suggest that anybody involved in grain marketing go at least one time to the Chicago Board of Trade to see what happens. It's basically a big option, or a big auction. It's quite chaotic, actually. It seems to be chaotic, but there actually is a method to the madness. Open range, the range of prices by which buy and sell transactions took place during the opening of the market. When it's open, the opening range, say it opens at $5, goes down to $4, and has a high at the end of $6, the range would be $4 to $6. Options, we've talked about quite a bit. Contracts that give the buyer the right, but not the obligation to buy a commodities or futures contract or to sell a commodities or futures contract. The right to buy is called a call. The right to sell is called a put. Okay, sorry about the disruption there with kids getting home from school. But anyway, back to the options. Again, the right to buy a commodity is a call. The right to sell is a put. Options are traded based on some predetermined price called the strike price for a fixed period of time. It's still used by some to incorrectly refer to the futures contract itself. But again, these operate a lot like insurance. You pay a certain amount of money. It allows you to stay in the market. Again, you buy a call. Price goes up. The call increases in value. If you buy a put, you're expecting prices to go down. Prices go down, it'll increase in value. But you can also sell calls and puts, which are a lot like doing a futures contract. Then you have to do margin and such, and your loss is not limited. The option premium is the price a buyer pays for the option. Premiums are arrived at through open competition between buyers and sellers at an auction. Out of contract, a buyer or seller who has not fulfilled contractual obligations. Out of the money is an option whose strike price is away from the current price and that there is no value to the option. This will expire worthless unless a futures price changes. So again, an option whose strike price is away from the current market price and has no exercise value. An example of that is you buy a 20-cent option on $5 corn. It's a put option. The price goes up. As the price goes up above $5, that put is going to go down in value and eventually will become not worth much of anything at all. And definitely at a point they become to the point to where paying the brokerage fee isn't worth getting out of the option position. Overbought is a technical opinion that the market price has risen too steeply, too fast in relationship to fundamental factors impacting price. Oversold means that the market price has declined too steeply and too fast in relationship to the fundamental factors impacting it. Fundamentals have to do with the amount of supply, use, anticipated production, actual production, and how much is bought or sold accordingly. A position is a market commitment, either long or short in the market, either bought or sold. A positive basis we talked about, the local price, and should probably change this to corn as prices have changed since this was originally done. And I'll make that an elevator, but the local price is bidding at 610. And the futures price closes at 605. The basis is +5. It's a negative basis. Probably a good time to look at selling. The premium on options is the price or cost of an option. Price risk is associated with possible changes in price. A put is an option opposite the call, giving the buyer the right to sell a futures contract at a specified price, and it usually means that they're expecting prices to go down. You're locking in a floor. Roll is simply to move a cash green or futures position into a different, usually later slot. In other words, you have a December contract, you want to get out of it and roll it over to March. It's not quite as simple as that, because basically then you have to pay another set of brokerage fees if you're in a futures contract. And the elevator is going to want something for that too, as you had a contractual obligation, but some of the contracts do allow you to roll it over and to keep rolling with it. A round turn is a completed futures transaction. In other words, you're getting out of your position. If you sell a contract and you buy it back, the buy and the sell is the round turn. You buy an option and then you sell the option, that's a round turn. Short, one who has either sold futures contracts or cash commodities. A short hedge is selling futures contracts to protect against a possible declining prices. A speculator is a market participant who has absolutely no interest in owning or selling a physical commodity. They're just doing it to take on risk to make a profit, and it's called paper trading. Spot price usually refers to the cash price for a physical commodity on that given moment or day. A stop order is an order that becomes a market order when the commodity reaches a particular level and you want to stop your losses. A sell stop is placed below the market, a buy stop is above the market. Basically, you're limiting your exposed risk in the marketplace. Okay, we're going to stop this one on number C and next move to number D, so I anticipate that and look for that in the lesson.